People often ask me, where are we headed from here with respect to the markets? It's what a lot of these commentaries are about, but the information we share might not be for the reason you think. We discussed this week. So where do we head from here? It's an understandable question that's on people's mind. It's certainly a question we're happy to walk through with people, but I wanted to talk through three quick dangers that I see in listening to too many people or trying to take in too much information around the world as it comes to making actual investment decisions. The first is the danger of feelings. Be wary of commentary or commentators, and I see countless professionals even doing this, where they're telling you about how they feel to try to predict the future. The reality is people are garbage at predicting the future, number one. Number two, to the degree that you should do anything with sentiment, you usually should trade against it. So as we warned you earlier this year when sentiment was reaching almost 100 on a scale of 1 to 100, hey look, at some point, sooner rather than later, this is going to mean revert a little bit. This is not sustainable. Didn't know COVID was happening. Certainly I'm not in the business of trying to time markets, but didn't surprise us that something triggered, of course, a market correction, or in March's case, a panic. Similarly, in December of 18, or March of this year, when sentiment got down to the single digits, we told you, this is kind of the classic signs of a near-term bottom. And this is not the time to sell everything out, cash everything out, despite all the feelings that we all had, of course, as general investors, or you might have been hearing again on TV, print, cocktail parties, etc. The second danger, I should say, is the danger of time frames. You've got your own plan. You need to know it, you need to build it, you need to know it, you need to stick with it. The person commentating in an article or on CNBC and their time frame may be completely different than the time frames that you're in. The asset class they might be referring to may not be the same version or asset class that's comprising a lot of your portfolio. So again, unless you're going to be a day trader watching some of the squawk talk type stuff where guys are trying to predict this and predict earnings, it's not relevant for you. And so trying to, as I've seen many people do, extrapolate that into something that they should be doing within their own portfolio is not only a waste of time, but it's something that's likely to lead to bad decisions. Similarly, someone might be talking about how great they think things will be over time, but if you got 6 months until that cash needs to go buy you a house, our recommendation time and time again is, hey, look, be aware of your time frame. Don't put that kind of money at risk based on something that might play out in the 7th month or the 7th year, but clearly after you would need the money. Lastly, the danger of style mismatches. And I wanted to cover quickly 3 investment styles in general or philosophies: fundamental, quantitative, and technical. Some people are all about one. I try to pay attention to all 3. The reason for that is the machines pay attention to all 3, and the machines run 90% of trading. And again, not that we're trying to trade the markets or day trade, but it helps us, again, the theme I want you to have here, be emotionally prepared. If we see something trigger, for example, this is real world, at 3,200 on the S&P and quickly fall, we would understand that that's just a normal reaction to how the markets looked at that moving average. So they're looking at things from a technical perspective. Similarly with investment sentiment, we start to see certain levels crack on that. We wouldn't panic about those or try to chase them. We would understand how to put them in context and again, not make an emotional reaction. So again, technical tends to be market chartist. 250-day moving averages would be a classic example. Quantitative is survey data, investor sentiment, other polling, economic rates of change, etc. Fundamental, the one you're most classically familiar with, earnings. How's the economy doing? Is their earnings growing? What's their PE? Tried and true over time things that play out. The quantitative and the technical, to quote Benjamin Graham, more of the voting machine, the emotions, trying to quantify the chaos of humanity. Fundamental, the ultimate weighing machine of what moves markets over time. So what's the time frame, the style, understand who you are. Take all this data in if you're so interested to be emotionally prepared so that you avoid panic decisions and surprises, but at the same time understand a great plan and a great portfolio, whether it's a current correction or an upcoming election, needs to be prepared today. There are pieces in place, a plan in place that is going to work whatever the future holds. It's the thing we love to do for all of you. Appreciate your time and attention. As always, if you've got questions about this, feel free to reach out. Thanks.